begin a little bit with your North American fund, which has just won this award for the 4th year in a row. After the election, it seems like it's tough to not be as much tilted towards the U.S. as absolutely possible. Is that the case?
Is it an American first world post-election? It certainly seems like it. It has been so for the past decade and certainly for this year. And I guess with the incoming Trump administration, the policies are geared towards an American first world. And so we've seen that excitement in the stock market, especially in the week when he was elected.
So you were quite well positioned going into, a Republican win ultimately.
I wasn't specifically calling for that, but the fund did perform well, absolute and relative to its benchmark that week. And so I do think so. Some of the areas that I think could benefit could be U.S. financial stocks because of perhaps a lighter regulatory bent towards them, which could impact them in terms of lighter capital required. Also, you could see M&A has been very depressed given the U.S. regulators' view on preventing any mergers. I actually had lunch with one of the largest U.S. bank CEOs 2 weeks ago.
What did he eat?
And he didn't eat. He actually just drank Diet Coke. I definitely ate. I ate 2 sandwiches.
Good.
And
his as well as yours. Well, it's good to stay caffeinated. I mean, there's nothing wrong with that. So what did he say?
So he said that regulation has, and this was before just before the election. He said regulation has been depressing corporate sentiment for both enterprise as well as small and medium-sized businesses. It's one of the biggest thing, as well as higher rates, which are starting to come down. And then secondly, he said for M&A that any deal size above $3 billion is going to be heavily scrutinized by the regulator, and that it would take 15 to 18 months to complete, and their client would have to be prepared to sue the U.S. government. So many of them didn't want to do it. So I would think now that that's a much better environment for M&A, for IPO. So I think for the investment banking and markets business, it looks quite good as well. I think there's other areas that can benefit. There's some negatives too, but go ahead.
Well, yeah, I was just going to ask. So financials clearly, because they'll be running the deals and they'll be making them happen. Are there particular sectors where you see that, where you branch out into because there are companies that would, ultimately be merged?
Well, I think that, so I'm not trying to play buy the targets likely, because I think then sometimes you get stuck owning a company if you're wrong that you don't like, and it doesn't compound. And so for me, I'm looking for high quality companies that can compound their free cash flow, and so I don't want to bet on M&A. But I do think that the policies probably benefit U.S. domestic focused businesses, probably within industrials. I think that there's some policies which are kind of scary on the tariffs that could be implemented. So any company that's importing a lot of what they sell, such as retailers, could be at risk, as well as U.S. companies that export because they could face retaliatory tariffs. But I do think you're right, and I do have my fund position. I think it's 73% or 74% in the U.S., which is a little bit over its target benchmark of 70% U.S.
Okay, and the performance on that fund, the North American Equity Fund, has been excellent.
Thank you. Thank you for saying it. It's having a very strong year.
It's a company. Natural resources.
It's done well this year, both in absolute and relative. I run the mining and materials side of that fund, and my colleague Joe over to Vest. He runs the energy side. He's having a great year. He's doing really well. He's in particular done well on buying royalty businesses where they collect a royalty as opposed to buying the actual exploration and production business, as well as energy services. I think on the mining and materials side, it's also done well. It's done well in terms of gold miners. It's done well in terms of some copper miners, despite the pullback in the copper price, and then some very idiosyncratic. I think when people think of materials, they think of mining, they think of commodities, very deep cyclical businesses. It's either feast or famine, but there are some actual high quality businesses that do have monopoly type of businesses that can compound. So for example, where do we see that? We see that in paint, coatings businesses, particularly when you have one large market, you're number one in that market, and your customers are more fractured. It gives you a lot of pricing power. Price is almost everything in commodity types of businesses and even other types of businesses, like having that pricing power. Aggregates, what's aggregates? It's like gravel and rocks used to build roads and also to build like all these mega projects, right? When you talk about industrials, all the nearshoring mega projects, that's benefiting companies that do aggregates. And so they're getting massive price increases. They're like US focused, they can benefit from. One of the things we didn't mention when we talked about the Trump outcome was lower tax rates for corporates, particularly for US focused businesses that tend to have higher tax rates. So they would benefit there as well.
When we spoke last, you were taking a look at kind of mass amounts of design companies for infrastructure, essentially, and there was a lot of that going on. I'm sure that's all still playing out, and it's actually being built with things like gravel and all the things you're just talking about. But is it investing wise? Has that, I don't know, has that petered out a bit?
That's done really well. So you're talking about the engineering and design companies, and I'm actually invested in the Canadian ones. And so I do own two. I won't mention the names because they're not in the top 10, but there's three large ones in Canada. I own two of them. One is has a very idiosyncratic thesis in that I really like the core engineering and design business. Why? Like it's like a consulting business, so it's capital light. It's not that cyclical. It has really good near-term tailwinds in terms of organic growth and higher margins. But this particular company is also going through a transformation where they're exiting a cyclical bad business, which is construction, and they also have another large infrastructure asset which they could sell going ahead, and it's done quite well this year. And so maybe when I bring this up, I should mention for the North American fund, although it's like the target is 38% Canadian, it's less than that today, don't think of that as a separate Canadian fund and a separate US fund. The way that I think about that is owning the best of Canada. So I own two Canadian stocks in my top 10 today. One is Constellation Software, the other is Brookfield Asset Management. Maybe we'll get to those later if you have
we'll
interest.
get to them right now.
But I also own these engineering and design firms, right? And so that's the way that I would like investors to think about this fund.
And you've often approached things. You came originally from private equity. It's, you really want to be an owner of this company and look at it sort of from the bottoms up which is amazing. Do you want to talk about the couple that are in your top 10 that you just mentioned there?
Yeah, sure. So there's Constellation Software, which I've owned
long time,
for a long time, I think since the inception of the North American Equity Fund. And so I really like the business model. I like the CEO. What do? They own vertical market software companies. So don't think like really fast growth, expensive companies that don't generate cash flow. Think almost the opposite. Very, very sticky business, repeat customers, very small like price increases. So the organic growth rate is actually not that high. It might only be low single digits to mid single digits, but they generate a lot of free cash flow and they're able to deploy that into buying other vertical market software businesses, which they've grown the top line and more importantly, maybe the bottom line and cash flow rate over time. So they've done really well. One thing I like about the CEO and the management is they own a ton of stock. And I think the policy is to buy, I think it's approximately 75% of their bonus goes into buying stock in the open market, which really aligns them well with, I think, their shareholders. And then two, they've also divested parts of their business in order to grow faster, which is a rarity that you see. Most CEOs want to just grow the size of the enterprise. The other one is Brookfield Asset Management, which is probably well known to investors. But it's an area that I like. It's not the only company that I own. I also own a large US company in the alternative investment space. I think that there's going to be very, very strong growth for the next long cycle. This is one of the
secular
right,
trends.
I think it's a secular trend of growth in private credit, also infrastructure, renewable energy. Like think about all the massive things that need financing, like in terms of infrastructure, renewable energy, like AI data centers, and also just
fix things
private,
up here, don't you
think? Yeah. Well, if anyone's driving or drove to work this morning, I'm sure they're going to agree with you.
To fix a few things here. Get on that. It's kind of fascinating. Let's come back to what companies will be dealing with lower taxes in the U.S. And again, we've got the Trump era taxes that will reset in 2026. So that's one piece of it. But the corporate tax environment for companies in the U.S., and it will alter, I guess, between states to an extent. I mean, it must be massively material to some of the companies you're investing in. Are you kind of re-looking at things to see how that will actually potentially play out, or do the algorithms for it?
A little bit, and definitely our large team of analysts is doing that. They are deep in the weeds, and they just to remind our investors, they model out the three financial statements out like several years, and so it's something we look at. I think in general we can say that U.S. domestic companies will get the largest benefit, and I think more global companies that are able to better manage their tax rate, probably it's less of a benefit or like less of a change for them. But I think when Trump did enact tax reform, corporate tax reform in his last administration, I think some of those tax cuts, as well as a policy of accelerated depreciation, was set to expire. And so there will be some winners. And so we know which ones in the portfolio are the winners or potential losers or just not winners in that. And so, yes.
You can adjust to whatever needs to happen there. Are there other places that you would be thinking about rotating into, or what can you sort of provide on this slightly new dashboard of a new administration? Policy will fall where it may, and we have a fairly good idea of what that might look like. So you mentioned financials. Is there anything else to update investors on that you're keeping your eye on sector-wise, I guess?
Yeah, I think that just maybe a little bit more of a focus on the U.S. and U.S. domestic focused businesses in the terms of sectors. U.S. financials, industrials, and consumer discretionary would probably be the ones.
Consumer discretionary as
Yes.
well. Yeah, interesting. The consumer seems to be just very healthy in the U.S.
Yeah, so Walmart reported this morning, and on their conference call, they publicly said it's just very stable. And they also announced they're seeing very good growth in the above $100,000 household income cohort. So
yeah.
I think that, like, if you think about the market's been so strong this year, and at the beginning of this year and at the beginning of last year, everyone was very fearful of a recession and rising inflation and higher rates, and we really haven't had any of those things. So as they say, the market climbs a wall of worry, and so that's happened, and that's in part why we've had a strong market last year and this year.
An area of sort of the industrial complex that I think we'd spoken about at some point is actually aerospace. There's a lot of change. There's a lot of not very good airplanes that also need some fixing up out there. Darren, if you get on that. What do we think about the aerospace space?
But I like that
going through changes.
I like that you made that comment, right? And so, like, you're right, like, it needs fixing up. And so Boeing and Airbus are having problems, and they're really behind, but what that has the effect of doing is just extending the cycle. And so it's that cycle of growth and deliveries. And so as a result, I think there's been opportunities on both the OEM, like the equipment manufacturing side, maybe not the OEMs, but maybe the companies that deliver parts. And so
many parts.
So, and also the companies that do the aftermarket, like the aftermarket servicing of the airplanes, that's just like a sticky, recurring, high margin, non-cyclical business.
Right.
The thing about these businesses are they have like little monopolies within their businesses where they get sticky growth, like high margins. So I really like aerospace.
What's an example
and I think
of that, like sort of small areas within?
So if you do the aftermarket and you make the part, like you may be the only company that's able to service that. And so you get very high margins, or there might be only one of two companies on the parts that can sell the part that go in an engine or other parts of the aircraft. And so you typically get very high margins. So I like investing in monopoly businesses. I think this is a long cycle. This area has done very well for the fund this year, and I'm continuing to look there and see how I can continue to own stocks. And if there's anything that has better risk reward, we will pivot that way.
Within the North American Equity Fund, which areas, I don't know if you mentioned this, we were talking about, but so you look generally more towards the materials within the Natural Resources Fund.
That's right.
But within the North American Equity, what part of the commodity complex do you like to have in there?
So it's pretty small right now, actually. Okay. I would say for energy, it's maybe around 1-ish% of the portfolio. And for materials, it's a lot higher than that. Maybe it's 8 or 9%, but I would say of the traditional mining, it's probably 1 to 2%, and then commodity chemicals is 1%. There's one very idiosyncratic story I like there, which is just a free cash flow machine, and I love those kinds of stocks where it's cheap and they just give you a lot of cash back. Other than that, it's some of the companies I mentioned that are more higher quality, have good growth, have monopoly types of businesses like coatings and aggregates.
You know, one topic that I feel like we never stopped talking about GLP-1s, I don't know, about a year ago. And all the, you know, and the Walmart CEO was being asked, are you worried about people buying groceries because of the GLP? I mean, everything had a connection to GLP, everything did. And a lot of things kind of got sold off actually on that. It's an interesting area to come back to. Is that an area that you come back to? Did you look at healthcare broadly, but sort of specifically in that area?
So yes, I did, and I really followed that, and I did in the past own some stocks that sold GLP-1 drugs. But what I think a really big opportunity and a way that the fund benefited this year was one of the sectors that was very hard hit. You mentioned like food retailers like Walmart, but also like the food and beverage companies. But another area was med tech, so medical device companies. Boston Scientific is in the top 10 for the Fidelity North American Fund, and so they're fairly diversified across different areas like cardiology, but all kinds of medical device companies stocks were hit very broadly because people thought, hey, everyone's going to be so thin and healthy
and fine,
that they won't need like hip replacements, knee replacements, like stents for your heart, any of these things. And so these stocks, the multiples came down, and so they've been really, really good stocks this year because maybe they started at a low point. And then for the ones that we've owned, like Boston Scientific, they've had like really, really good execution. They've had 2 new product launches that have over-delivered. You know, our analyst in that area has done a really great job in helping me and our other funds invest here.
It's a really interesting area, as you say, sort of the devices side of things, because it can be everything from like the robots down to just actually what we have replacements with, right?
Exactly.
And that was an interesting story after COVID as well. Is there anything you'd like to say about the currency trade-off? So, I mean, unfortunately, the headline in everything is what our Canadian dollar is doing. Now, in the fund you're talking about itself, you're very much exposed to the U.S. and therefore the U.S. dollar. But just a couple of comments. I mean, you must keep a pretty close eye on this.
Yeah, you're right. So the fund's benefited from that heavy exposure to the U.S., with the U.S. dollar being stronger than the Canadian dollar. But I'm sympathetic to anyone who's listening to this that's going to be traveling to the U.S. because you're going to feel it with the Canadian dollar being weak and the U.S. dollar being really strong. So for me, I generally like the exposure to the U.S. dollar because I think the U.S. economy has good growth prospects. I call the fund investing in North America, Fortress North America, but I think the U.S. in particular has very strong growth prospects, stronger than Canadian. And so I like that. I also think the U.S. dollar tends to be less cyclical, so it probably tends to smooth the volatility of the fund's performance, which I think is another good factor.
Right.
I don't want to call the currency, the Canadian one is cheap, but I think that generally the currencies respond to the change in differential and interest rates, and that's driven often by economic growth, and I think economic growth looks stronger south of the border than north of the border, so I'm happy with the current positioning of the fund.
Yep, okay, fair enough. Do sort of the macro, exactly the differentials, how many cuts we need to do here to sort of get things going? We had some economic data coming in this morning that seemed fine, but not awesome necessarily. What do you think of the Canadian economy? Are you worried about it? Are you concerned about it when you look out to it? Are there enough places to invest, even if you want more there in the U.S.?
I worry about the Canadian economy, its interest rate sensitivity, the consumer mortgages resetting, and what that means for the rest of their consumer spend. Immigration is slowing, so I still think that'll be a tailwind, but less of a tailwind than it has been. Having said that, I probably worry about it less than I did like 3 months ago or 6 months ago before the Bank of Canada started easing rates. I do think longer term there's this issue of lower productivity growth in Canada, which I do hope as a Canadian does get addressed.
Yes, absolutely. Question rolling in here. So if regulation were to be relaxed further, do you see greater M&A and consolidation? So I think that's the U.S. I mean, we could talk about it here too, but I think that's referencing to what you mentioned at the very, very beginning.
Yeah. The other point I'd make on sort of just coming back to the prior question is, I think the big story though is everyone thought there was going to be this recession and we still haven't seen it yet. That might be the bigger story, right? Then the outlook has been like, I think it's generally pretty stable, and like honestly, I've focused more on stock picking than I have on macro, and I think that's what's one of the drivers of returns of the fund. So 2 on M&A, shouldn't be a change in Canada because there's not a change in government. I guess there'll be an election next year, so we'll see. But in the U.S., yeah, I do think that there will be more M&A, a pickup in M&A, and you've seen small and mid-cap stocks benefit as a result, and you've seen companies like U.S. banks that have capital markets exposure benefit as well.
Yeah, actually, let's come back to that recession that I often talk about it sort of as the wild root of the expectations on rates from the beginning of this year, thinking there'll be 6 rate cuts, and but actually the bigger story is that here we are still sitting here and actually thinking that we might have bypassed the whole thing in terms of a recession. So where are we in a cycle? Does it matter to you? You just keep looking at the companies, I guess.
It's hard to say. I kind of just think of it more as mid-cycle, but I think the economy's stable. I think inflation's come down, it was above 8%. Now it's kind of closer to a more normal range. Looks like inflation continues to fall. Walmart, just referencing Walmart because it's fresh in my mind, they reported this morning, but they talked about for food and their discretionary baskets, they're not seeing inflation. Obviously, there's other parts of the economy. So it seems like it's a better outlook, and it seems like we've climbed the wall of worry. I mean, I do think that stocks are more expensive and sentiment is hotter, but I think, overall, I think it seems like a pretty good backdrop for investing.
What can the banks also do with perhaps less regulation? So we've talked a little bit about less on the capital requirements, so that's good. That capital will then go potentially where? M&A is one area that we might see sort of borrowing to do that kind of thing. It's a release of capital into the market. Where else does that filter down that might be of interest?
So we need that regulation to firm up finally.
Like this Basel III stuff,
exactly.
Whether it's going to actually...
Exactly. I don't want to get too much over my skis talking very specifically about it, but I do think that there was the opportunity where they require less capital. I think that the hope would be that they return capital to shareholders. I think where it ultimately goes, I mean, it's going to go back to investors. They probably buy other stocks. It goes into the economy. So I think there is a benefit also for society.
Brilliant. Okay. So what would you like to leave investors with? You've had a brilliant year. Actually, this fund had 4 brilliant years. What do you want investors to know that you're chugging away at?
Look, I'm really excited. I like what I own. It's been a good year. And just keep in mind too that I'm the largest owner of this fund, and it's my major financial asset. So whenever I buy a stock, I think, do I want to own this stock? And if the answer is no, I don't buy it. And so if you want to come along on this journey with me, then you can own the fund as well. And so it's probably good for investors to have a portfolio manager that's aligned with them on that. 3, it invests in North America. I think North America is the best place in the world to invest. It's the most innovative. It's got the largest and best growth companies. 2, it performed better in an inflationary world. It performed better in a geopolitically fractured world as well. So I like where it invests.
Yeah, very interesting way that you go at it. Darren Lekkerkerker, thank you for joining us here today.
Thanks, Pamela. Awesome to be here.